they take a 49% stake and they get 75% of profits back until that 10 billion is paid off. And from that point forward, I think they get their stake, which is 49%.
Is
So
Microsoft Kevin O'Leary?
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
I'm done. I'm done, Skippy.
What?
I'm done gatekeeping.
Are you talking TikTok finance?
I am done gatekeeping. The people need to know the secrets.
I hope you're talking TikTok investment.
I am.
This leads exactly into what I was going to talk about. I think I can make a TikTok invested video, Doogles. So
I think so.
I'm not claiming anything. I've had a nice first 2 weeks of the year. One of my portfolios is up 16%. And I just did the math. If I can just repeat that performance every 2 weeks for the rest of the year, I can turn $10,000 into $400,000, Doogles. Let's make a cute video with like some cats and
why
it's going to take off.
I've been telling you for decades now that I've known you. You think too small. Why just extrapolate just this year?
Oh, yeah. Good point.
Think about 10 years from now. Think long term. Think long term.
If my performance continues, I could have all the world's wealth in 7.4 years. I mean, I'm making up numbers here, but
yeah. By the time I am Warren Buffett's age. Oh, yeah, it's gold. It's gold. All right. We'll put the actual video on the Substack on Monday. We don't need to talk anymore about it.
It's so bad.
It brings laughter.
But so when I'm having a rough day, sometimes I do head over to at TikTok Finance at TikTok Investors, on Twitter. And they're just basically stealing stuff from TikTok. And it is hilarious. This one was about what? You just have to think about money coming your way. You're going to be the wealthiest person.
If you're only thinking it, you're not going far enough. You got to say it aloud. You have to think it and then say it aloud. And then it happens. And she's dropping F-bombs, like expletives on this. That's the conviction. That's the level of conviction. All right. Let's transition us.
Yeah. Okay. So we're going to transition to Tesla. It's just too interesting not to talk about, but it ties into a lot of other things. I just talked about how the past few weeks have been good for value stocks. What's crazy about that is, and we've talked about this on the show, the valuation spread between growth stocks and value stocks is basically at an all-time low. That's flipped recently, and the value community that I hang out with has been freaking out because we're not used to good performance. It's been a long, dry, harsh winter, Doogles. But here's the stat I want to talk about, and then I'll tell you how this relates to Tesla, because this is purely reversion to the mean as a hypothesis. And I think what's happening with Tesla negatively is purely reversion to the mean as well.
Sorry, have we ever talked about reversion to the meme?
I'm having a rough morning, man. I'm sorry.
No. You said mean. I just thought about reversion to the meme, and I don't know if that's ever been a thing. You can keep going, but I'm going to do something with that.
So our boy Drew Dixon did a breakdown. He's also what I consider expert on Tesla, but he did a breakdown on this valuation spread using the Ken French data set. Ken French is in pharma and French. Ken French is up at Dartmouth. And the last 6 times the valuation spread has been this great, here's what the next 5 years performance looks like for value stocks. Up 20%, up 60%, up 40%, up 20%, up 50%. And most recently in 2009, over the next 5 years, it actually lost 2%. Took us all the way back down to where we are today. So we're more than 2 sigma away from the standard measure. And when that's happened before, you have 5-year performance of roughly 50 to 60%. It's a great time to be in value stocks, Doogles.
At least not a bad time. Do you know how they measure value stocks? Is like a Russell or do they use
Yeah,
some kind of
and
index, something like
it's
that? Okay.
a lot of this is still based on price to book, which isn't the best metric,
Yeah,
but
but still,
yeah, it's pretty old school, but directionally it tells you where you're
in
going. And
principle.
the fun part about these data sets is like you can go back to 1921 often.
Yeah.
This one's only back to the 50s. But where that leads us is the Tesla investors just losing their mind, Doogles, because the performance of that stock has been rough. Now, why does it
True. True.
why does everyone think the performance of that stock has been so rough?
They throw out Twitter, right?
Right? Yeah.
As we talked about
Musk
before.
Musk is distracted. He's has his mind elsewhere. No, what's actually happening here, and we talked about this in a previous episode called Tesla versus the World. The market cap of Tesla was greater than the market cap of all the other legacy car makers. Many have been around for hundreds of years, or at least 100 years combined. Like the valuation just got crazy here. And people said, well, Tesla's not a car company. Like Tesla's a technology company. So that's how we're going to buy the thing. Wall Street Journal did a brilliant article this week. It's by Rebecca Elliott. And the title really says it all. What if Tesla is just a car company?
Go figure. Go figure.
So
it's powerful. I mean, because you're right, though. Like the justifications for Tesla's valuation were coming out the wazizi.
Yeah.
Right. There was it's really about the batteries, and batteries are going to fuel the future of the world. So the cars, whatever, it's a platform play. There's so many things that you can use to justify multiples that car companies don't get.
Mm-hmm. And you can sell software and services.
Yep.
Because it's always connected. So what this article details is the competition. I mean, I always like to talk about when your profit margins are great and when consumers gravitate to your product, what that does for your competitors. And so it talks about all the Tesla talent that's left. That's now it's places like Ford and Jeep. It's like even those people's criticism of the company and saying there's one guy that works at Ford that cracks me up. He basically is saying, yeah, but Tesla's designs are so basic. Like I love the technology, but I was never really into what the cars looked like. And at Ford, we get to be more creative with that. You have the Ford CEO saying, Tesla's awesome. We have learned so much from them. That's why we're hiring their talent. But our bread and butter is elsewhere. Like our bread and butter is in trucks and Mustangs and those sort of things. So we can make this whole different set of amazing vehicles with amazing technology, stealing their playbook, but then we can go and do our own niches where they can't even touch us. And the price points are something that's crazy. Basically, just this weekend, within the past week, Tesla reduced some of the prices of their models by up to 20%. I mean, I have a friend that just bought a Model Y, right? The price of that would have been $63,000 like 3 weeks ago. And now they lowered the price and it's eligible for a tax credit. Now it'd be 45. Can you imagine if you just bought something and effectively $20,000 disappeared in the air? I mean, I think that tells you a story. It tells you that their margins are clearly under pressure. In terms of stock performance, I just wanted to pull up a graph. In the last year, they're down 66, 67% roughly, all the way from high flying in the 380 range down to 122.
It's killer. It's killer. I was seeing this. Hold on, let me look this up. I think it was in the like big picture, you know, that the Ritholtz wealth management guy whose name I can't remember right now. Oh, Ritholtz. It's
Barry Ritholtz.
Barry Ritholtz. His blog, he had this image. I'm gonna look it up while we're talking here, but he had this image where he was showing he called it meme stocks. It was like he didn't call it. It was a graph from someone else, but it was like a table of meme stocks and where they hit their maxes and where they are right now. And they weren't all meme stocks in my mind, but there were some, we know intellectually there were some wild swings that went down. And looking at this, I pulled it up now. Looking at this, there's again, some of these I didn't really see as meme stocks. It's just really the wild rides. I'll give a couple examples here. You've got, so a couple knowns first. GameStop hit a peak of $120.75. So $120.75. Now $18.46. AMC $72.62. Now $4.07. Beyond Meat $221, $12.31 now. Clover Health $28.85, now 93 cents. I'm just throwing it out.
93 cents.
93 cents. Yeah, so it has some good company.
Oh, it definitely does. A few more stats from this, and then we'll move on. Number of electric vehicles available for purchase in the U.S. 5 years ago, there were 18. Today, there's 53.
Yep.
And some of those are being received with rave reviews. Some of the Hyundai and Kia stuff, some of the Ford stuff. Like, there's so much competition in this space. This article details companies I've never heard of before that are going after Tesla's high-end market, and then the long-term, well-established automotive players seem to be going after the lower end of the market. Their vehicles are typically less expensive. There's just competition everywhere. And the other stat I wanted to mention, I talked a little about their performance. Their peak market cap was $1.24 trillion. Their current market cap is about $390 billion. In my opinion, well, not even my opinion. Like, if you go to someone like Drew Dixon, who really follows the stock, I've seen him do a back of the envelope analysis that says the stock might be worth $55 a share. Again, it's currently at 122, and that's down 70-ish% from where it.
That sounds about right. Another 50% drop, and it's probably appropriate. It sounds about right.
I mean, and even appropriate is probably like it's being valued as a hot, popular company with lots of growth prospects.
Yeah, I'm
because
not saying
even
cheap.
though they, yeah, that's my point.
Yeah, it makes me think about a blue ocean strategy to get real.
It's like I'm sitting in a cube 15 years back hearing about blue ocean strategy.
Exactly. So the quick hit here is blue ocean strategy was, you're right. I mean, it was like 20 years ago, 15, 20 years ago.
Yeah.
A couple professors from INSEAD were talking about this. And the thought was, if you take the ocean, when it's wide open and beautiful and amazing, it's blue. But then, and say that that's an industry, for example, then when there's a lot of competitors, there's blood in the water, right? Everyone's out for guts and glory. And so the ocean turns red. And most industries, as they mature, they become red oceans. So they're really, really competitive. But if you think about what the next wave of innovation might be, what the new trends are, you can then take what that industry thinks today and like evolve it into this blue ocean strategy. So it's like just thinking additionally. And the reason I thought about this, so one, there's a book called Blue Ocean Strategy. Up to you whether or not you get it. I
don't get it.
But like, but yeah, but the reason I'm bringing it up is because I think the whole blue ocean strategy idea with regard to Tesla was probably that this was like new, right? This is a whole new avenue that other people couldn't necessarily touch. And then everyone was like, no, we're going to touch it. Like, and maybe it wasn't a blue ocean after all, right? It was just like, it was a story around a blue ocean. But the trend was already fairly, if not known, I think like thought about. And then Tesla was so public around, like there was so much jazz around Tesla. If you think about if Tesla were like a quieter organization, right, that didn't have as much fanfare, Elon Musk wasn't all up in the Twitters all the time and everything, they may have had a longer runway with a lead. But there's so much fanfare, such high multiples that it does, to your point of what you brought up earlier, like it then basically dares competition to come in because they see so many dollars.
Well, yeah, if you're that public about your success, it creates enemies or competition, right?
Just be
I'm going to squeeze in one more thing that I wasn't going to do, but you reminded me of it. So when we talk about mean reversion and 2 sigmas away from multiple and everything, I'm in the middle of a book. I'm sure this is why all our listeners listen to the show. The book is called The Misbehavior of Markets. Have you read this one?
Not that initially comes to mind. It sounds like a thing I would have read though, but not that initially comes to mind.
So Bernard Mandelbrot, I'm not saying that quite right. Polish-born French American mathematician and polymath. This book is dense, Doogles. Let me just tell you. I'm reading this book for the listeners. I do not recommend you pick this book up. But man, does he do a fabulous job of distilling down how markets were originally understood and modeled mathematically is based on a Gaussian curve. And in a Gaussian curve, the large majority of stuff happens 2 sigma away from the mean. And it's very rare to get something that's 3 sigma away. And this is the whole 6 sigma design process and everything else. It's like you get to that 99.7% of things happening there. So as mathematics around financial markets developed, people said, hey, look at this data. The Gaussian curve seems to fit. Everything's great. We built all our risk measures on top of that. When he actually looks at the data using his incredible math skills, which is why the book is so dense, he goes, wait, this isn't true at all. I see stuff at 9 sigma. I see stuff at 24 sigma. So this is where the fat tails discussion comes in, right? And it's basically like, what actually happens in financial markets, it's something that looks like a Gaussian curve, but then there's all sorts of events that are happening way, way away from 6 sigma. And this is the complex nature of events getting compounded on top of other events. And that's all I'm going to talk about because it gets really dense. But I think the main takeaway from that book is it's so important to realize that how you think about the rest of your life or how you think about building a car or these events that happen normally, you can't apply that to financial markets, because when things go bad in financial markets, the margin calls happen on top of the exchange rate risk, on top of the human nature freaking out, that like these things compound so rapidly where you get something that's a 24 sigma event that basically the mathematical modeling would say there's like, it's a 1 in 14 trillion chance of happening, but it actually happens fairly regularly in financial markets.
Very well said. And I just Googled this book, so I have not read it. Like, I'm looking at it. I have not read this book. What I love is the multiple sales points that at each stage, more and more people get turned away. So someone would see the misbehavior of markets and be like,
good.
I'll read on. Be like, maybe.
Maybe.
Then the next line is a fractal view of financial turbulence. You're like, okay, so now you've lost like another
less exciting.
20, you lost another 20%. Then they're like, okay, if we haven't sold you yet, Yale math.
That's exactly what reading the book is like. It like gets more and more dense all the time, and it's also pretty long. So
only Skippy is left.
But remember that markets have fat tails. It's an important takeaway.
Yeah, I'm gonna read it though. It sells me like it. So I mock it, but then I read it. Thank you. All right. Oh, do I want to go? So I'm dipping in the fishbowl. Do I want to go more decline and despair first, or talk about a spry Warren Buffett?
Let's go decline and despair, because I can piggyback on top of that with some more.
All right, that's the right answer. Okay, decline and despair. So we're going to talk about Japan, and specifically the lost decade of Japan. And we've talked Japan a few times here or there, right, on the show, and discussed the big bubble that happened there, and as well as, I don't know if we referred to it this way, but the decline, the lost decade. But I read this piece over sometime in the last couple of weeks that I thought was a pretty cool summary of it overall. It's titled Japan's Bubble Burst, the Party That Wasn't Supposed to End. And this is on kanochivalue.com. So before we even get into the lost decade, I want to give a few more stats into the buildup that happened before this lost decade, because Japan gone straight cray financially, and it's epic, like so epic. So here we go. Let's talk GDP first. In 1970, number one country in the world ranking by GDP is what?
1970? I guess the US.
There you go. There you go. That's right. US at $1.1 trillion had 31.4% of the global GDP at that point.
Okay.
Japan at that point was number 4, $213 billion at 6.2% of global GDP. Okay, so this is 1970. 1970 is kind of when Japanese financial-ish we started to see it take, well, not we, I wasn't alive, but started to see it take off, right? So now let's fast forward to 1995. So this is 25 years later. Still number one, United States, at 7.6 trillion. So the US went about 7x where it was 25 years before. Like, good job, US. Japan is now number two and has gone from that roughly 200 billion figure to now $5.5 trillion in GDP. So 17.7%. It went from 6.2% of global GDP to 17.7% share.
That's
of
massive in a 25-year span.
It's massive.
It's
unheard of. I'm going to give a few. So that's GDP. Now let's talk a little bit about stocks.
Well, so you and I were both really young in this time frame, but I mean, don't you remember this like mystique around like Sony or it like electronics coming from Japan? It was like, man, there was this, oh, if you can afford a Sony, the reputation related to the whole country almost of like, it's such quality, cutting edge tech.
It's where electronics came from, period. Like, period, right? Because you had on one side, you had what you were talking about, Sony. You had the Walkman, the Discman, anything you watch something on, like, came from Japan. You had on the video game side, you had Nintendo, right, which owned the day at the time with the NES and the Super Nintendo, right? And then so electronics just straight up came from Japan, like, period. There was no question about it. So yeah, absolutely, there was that mystique. In the background, kind of, I didn't really know about this at the time, but I'm gonna act like I did. In the background, we're also like the what's happening with cars and like vehicles. I know it was also happening then. So I was aware of Japanese vehicles, but I wasn't driving or anything. So like that wasn't really a thing that impacted my life, but the consumer side did. Okay, so here are a few stats. Start to 1970, Japanese stock market dropped by 15%. So it is what it is. Then up 36% the next year, up 92% the year after that. Then there was the 73, 74 crash, down 17%, down 11%. Then up 13%, up 15%. Then you start this wild ride throughout the 80s, really kicking in 1983. I'm just going to start reading. So I won't name the years, but just start reading from 1983 to 1989, the annual increases in the Japanese stock market. Okay, starting in 1983. 23%, 17%, 13%, 44%, 15%, 40%, 29%. That is from 83 to 89, the Japanese stock market.
Yep.
We talked about what happened with GDP.
Crazy.
Yeah, this is wild.
From memory, I think in 89, I think you probably have the stat in front of you. The Japanese stock market, it represents 44% of the world value for stock markets.
I don't have that right in front of me, but it was something like that.
Yeah.
It was massive.
And I don't know if you're just smarter than I realized, but you're blowing my mind here. I think it's recency bias. I think there's basically a parallel with what happened with Tesla as a stock and almost Japan as a country. We'll see if that holds true.
I mean, yeah, it's quite fascinating. So that's the buildup. So now you have the background to the lost decade, right? That's about to come up. And I'm going to give you some bullet points on then what started to occur. And some of this, some people will remember. Like, you'll see some analogous behaviors and issues to what we've seen otherwise, with one really key difference, well, a few key differences, but one really key difference is how long this took. Like, that's a really big difference.
Well, okay. So the reason my personal opinion on why it takes so long is because of how crazy it got. In this article, that it's called the biggest bubble in history. Mm-hmm. Now, I think there'd be some debates about that because there's been some massive bubbles out there. But the CAPE ratio in Japan at its peak was like 100. No other stock market in recent past has reached a CAPE ratio, no other major stock market, of more than 50. Like, this was twice the biggest bubbles that have happened in major developed markets anywhere. So as that pops, I think there's just lots of layers, lots of cliffs to fall off on your way down, which is why it lasts a decade and why it's so painful.
Yeah. And exactly right. And what always goes into bubbles is you do have these layers that you're talking about, because people start betting on the bubble continuing. They start taking out debt. They start becoming riskier and riskier. So as you unfold this thing, it's devastating. As we start off, Japan's on the verge of passing the US potentially, right? Still a little bit of distance, but as the world's largest economy. Okay, so that's the backdrop. So what starts happening is in 89, stock market starts to come back down to earth a little bit, right? So you've got 90 was down 39%, 91 down 4%, 92 down 24%. Like stock market coming down.
That's rough.
That's brutal. Like that's brutal. And that's brutal. And it's like the beginning, right? That's just the start. So you got these asset prices coming down. In about 93, so at the end of that 3-year hit, the end of 93 is when the economy actually starts freezing. So during this point, the economy was slowing, but it hadn't fully grasped like how serious this was. And by freezing, I mean like it's hard to find jobs, and all that kind of stuff. So then one of the biggest roadblocks, according to this piece here, was all of the, again, analogous, like the non-performing loans that you have. So like bad loans that were made by Japanese banks. And the Japanese banks eventually decided they were going to start to try and collect the loans. But lo and behold, when they go to get the money from the businesses, there is none.
Yeah. And
so they have these bad loans. The businesses themselves were effectively insolvent. And so there was no money to get there. And this is where the real human behavior comes in that exacerbates everything. And so there's no money there, but the Japanese banks didn't want to say anything. So what they did, and this is partially so the banks didn't want to admit their own issues. And I don't know the background of this, but according to this piece, the employees of the banks were on the hook in many cases for the bad loans too. I don't know how that works, but so there was this like double up situation where the banks didn't want to go under, and then the employees themselves would be ruined.
I mean, that's more common than I think most people realize. When you're even a mid-sized company, a lot of times you're asking for collateral from the owners for debt. So I think that's a fairly common thing.
And so then the next common thing is, so now, but eventually the banks had to say, all right, we ain't got no muns. Yeah. So banks are starting to write off the bad loans, big losses come up, and that sets off your typical cycle, right? Then in 1995, bailouts start. So the government bailed out this bank called, I'm going to get this wrong, but the Jusen Bank, Jusen. And here's when there's some corruption. So the Ministry of Finance, the Minister of Finance, who leads the Ministry of Finance, had this secret deal in the back end. They go, all right, Jusen Bank, I'm going to get the government to bail you out. On the other side, I get a piece. So the public is like livid that there was a bailout in the first place. And then this is like a fact that comes out. And so people are just like distrust exists wholesale at this point, right? Okay. And so you're like, okay, now we're at the trough of despair. Things start to go up into the right from here. No. Then there is a massive earthquake that hits, right? Causing $100 billion in damage. And so people are like, the economy is at its like wit's end. Earthquake hits. Things are really bad. So the Bank of Japan, the equivalent of the Fed in the US, the Bank of Japan cuts interest rates to 0.5%. And they cut interest rates so they could start to spark some demand.
I'm kind of joking, but have they been at 0.05% for the next 30 years?
I think they went negative at one point. Yeah, I think even recently they were negative. So they go 0.5%. And so in their minds, they're like, okay, we're going to, like, demand's going to start going out. People are going to loan money and whatnot. And the banks, it's kind of like what you've talked about, the Great Depression, people that went through the Great Depression before. Banks started turning away people. They were like, no, we think all y'all consumers can't pay nothing. So we're not loaning to you because you're all a bunch of junk. And so the banks don't loan out money. And so the 0.5% doesn't really do much for the economy anymore. And then this bewilders the crap out of me. The government then takes this and says, I think we should raise taxes. So you have basically a whole country of people that have no money.
What sort of stimulus is that, man?
I don't know. This is, I have no explanation for this. So the government raises taxes. Then the Asian financial crisis hits, not because of that, but Asian financial crisis was a currency crisis that happened in the late 90s, right? I think it sparked in like Thailand or something like that. So the Asian financial crisis hits. So things are just boom, boom, boom. And then finally banks collapse. And this was like in the somewhere 2001-ish period. Like the banks just collapsed. So that is the lost decade, that like 1993 to 2002. And if you all recall, remember 1990, minus 39%, down 4%, down 26%. So in the middle there, you had a couple like positive years of, for example, 0.74%. So you had a couple of positive years in there. But then in 96 to 98, you get negative 3%, negative 21%, negative 9%. Then you get a plus 37%. Something must have happened. This must have been when they cut interest rates or something like that. And everyone gets excited. But 2000 to 2002, negative 27%, negative 24%, and negative 19%. This decade, this is like in the US, as we discussed, right? We're like, does the stock market ever go down the year after it went down prior? Look at this.
It's such a cautionary tale. So one, I want a clarification. When you say the banks collapsed there at the very end, what do you mean? You mean their stock prices collapse?
No, they went out of business.
Done. Dunzo?
Dunzo.
Gosh. This is why I think it's this is why part of me roots for the stock market to continue, the US stock market to continue to come way down. Because if the bubble goes on forever, the pullback in the bubble then lasts for a decade. And the ramifications of that just psychologically are like devastating. I mean, you end up with a whole generation of people that were coming of age in Japan during this time that I'm sure their financial lives are different because of how they lived through this and what it meant for them in their day-to-day life. So I don't wish this on anyone, but it's a great thing to study.
And you're so right. Psychology has so much to do with the macro, like stock market as a whole, right? Because as we've talked about a few times, there's the belief that when you have the crash, like the US will come back.
Yep.
And if you never believe that, or if you, like fully, like it doesn't, because it means people have to deploy their own personal savings, their own finances to buy stock, and institutions have to deploy their finances to buy stock. And if not, you get, I can't remember what it is right now, but the Japanese just savings rate, like savings account rate, is wicked high because people aren't investing and don't necessarily trust, I think, in a lot of cases, the companies that exist there. They just hold onto their money. It's the equivalent of under the mattress because they're getting 0% interest effectively. So it's just, there's nothing that comes from it. That's what happens when you get the biggest bubble ever.
One of my favorite stats on the value side, and this is an obscure study that I've seen a couple times, is that value investing still worked in Japan during this time. That seems to paint a really good story. But even if it did, man, even if my portfolio, like I'm living in Japan in the 90s and I'm making a few bucks each year, the still bigger macro picture of how that impacts your friends and families and coworkers, like I still think you'd walk away with a terrible scar from this.
How could you not?
Yeah. I want to pull something out of the fishbowl that in a way I think is related, and it's a breakdown of public transit systems in the US post-COVID. They mostly focused on New York and San Francisco, but there's a few other ones in there. And this whole article, I just picture like a credit analyst underwriting bonds for the New York Metropolitan Transit Authority in, let's say, 2017, right? And they're just like, this is what ridership is. These are the investments we're going to make. Like, this is the easiest analysis I'm ever going to do. No one's ever going to stop taking the subway in New York City, right? No one's ever going to stop taking the BART in San Francisco. Well, imagine what happened, Doogles. COVID came and ridership is down. The entire economic model of these public transit systems is built on ridership. So let's talk New York. We'll compare number of subway riders in 2019 to 2022. This is the 4 weeks following Columbus Day. Monday through Friday in 2019 was around 6 million riders a day. The weekends were around, say, 2.5 million riders a day. Now, Monday and Friday are about 2.5 million. and the midweek, Tuesday, Wednesday, Thursday is maybe at 4 million, you're still down like 33% from where you were 3 years ago and
So
where
the
you
peak
had
days,
been.
the
Yeah.
peak
Like,
days are down. Yeah.
mhm. And then the weekends are more like 2 million. So big picture there is everything's down. Now, what happens when ridership goes down is you cash less checks for riders, which goes to maintenance and upkeep. It goes to the number of trains you can run. When you run less trains or when you have less populated trains, crime increases on your trains, which means you need a greater investment
Yep.
in your metro system. Like, you get the downward spiral. It's pretty easy to grasp, right?
Yeah.
Well, they're all in the downward spiral right now. Now,
It's scary.
Congress has passed some funding to help bridge the gap, but I think you see, the classic example of people moving to the inner city, it thriving for 20 to 30 years before people start to migrate to the suburbs, and then the inner city often decays, crime increases, and then you have to figure out how to bring it back. I think you see that happening with public transit systems in a way that was not planned for, and it's really difficult to address because of course you see the downward spiral happening here. I don't know, I find this fascinating. This is one of those like real estate type
Yeah.
things that's just, I'm so invested in it always, and I thought this article did a great job of laying it out.
Yeah, I think it's terribly interesting. And to your same point, it did make me think about SLG, SL Green Realty that you sent my way back in 2020 or something like that, which right now is hammered with like a 9% dividend or something like that. And it's effectively, does the city get revitalized anytime soon is the question. My bet, like, ever in the long term is like, yes, absolutely. Whether or not that comes true, we'll see. But like, that would be my bet long term is yes, absolutely. But over what time period? But this is just another data point.
And so then that's just the public transit ramifications of people commuting less, and the downward spiral of the people that really want to go back and commute, then having to deal with increased crime or worse schedules for trains, and then it becoming more taxing for them to commute, and it continuing down. The ramifications of that to the inner city or the corporate headquarters is less people coming to the office, which means the delis that serve those people and the coffee shops, right? They end up either really struggling or going out of business. And you just see that it eventually impacts the city as well. The question I want to ask, I don't know that there's a good answer, but the question I want to ask you is like, how do you fix this?
As I was reading this piece, I was thinking about that same question, and obviously don't have the answer. But the questions that were going through my mind is like, what are the various reasons that people would congregate in the city? Because there was so much focus around offices, right? And coming in for offices. And I was just thinking, like, what else? Like, what else could you put on to revitalize the city? And there are various things that people would do in specific neighborhoods to revitalize. You can think about, like, I don't have any answers, so this is lame, but I was thinking about like concerts, fairs, like just starting like investing in like entertainment and gathering of people, which people are more and more willing to do now. Maybe not as many, but just like completely do that to get people. Because my thought is, while some things like that can seem like one time, sometimes it's just about sparking the psychological influence and getting people, like, getting the operating muscle going, right? Of getting used to leaving your house, going into the city, feeling okay with it. Those first few times, people in New York that I talked about that were commuting in like every now and again, if you go back a year ago or so, they just started going back to go into the city for whatever reason. And they were like, ugh, like getting on the Long Island Railroad is like nasty. Like, how did I ever do this? Right. But I think once you get people doing that a few times, they're like, oh, okay, now it's like the old normal again. And if you can just have enough things that people are used to coming in, then I think it could help.
I used to be on a transportation board for a municipality, and it was always, the thought process was always like, because funding is always tough. So it was, if you build it, they will come type things. And everyone's envious of a DC or a New York or a San Francisco, right? But what is rare is if it's already built and functions pretty well, and then a shock to the system happens, like a pandemic, that changes people's core behaviors and resets. So yeah, I don't have any solutions, but I'm excited to watch it, because hopefully some of these municipalities take different and unique approaches. Like hopefully San Francisco tries something that's different than New York, and we can watch that play out in real time. And hopefully they have some success, because this could be core to the desirability of a city. Is the public transit options.
Fully agreed. Okay, can I hit on a young virile Warren Buffett?
King you ever. Yeah.
So I came across this Substack post, pretty awesome, I think. And the Substack post, it's by, to give credit where credit's due, it's called Necker's Minds and Markets. Frederick Gieschen, I'm sorry if I got your name wrong there. This out.
He's great. Nectar value on like all the social media stuff.
I've hit on like one or two things before, or like not hit on, but like read one or two things before, but hasn't caught my eye as much as this. And this goes back to a 1979 piece on Warren Buffett. And what I find super cool about that, Doogles cool, again, not Justin Bieber cool. What I find super cool about that is you're going back to Buffett in the kind of the early days. The real early days of Buffett are a couple decades before this. But at this point, Buffett's like early 40s, like something like that, right? So it's, I don't know, your core Buffett. I'm going to read something to you. This is the description by the author of this piece, which is John Train. And the piece back in 1979 was called Warren Buffett, the Investor's Investor. It was in Financial World, and John Train put it together. And one paragraph starts, Buffett, a genial, ruddy, muscular man. I won't even read the rest of the sentence. Like, there's no description, and there shouldn't be. Buffett's in his 90s. There should not be a description that says that. But this is the time period. I just want to transport you back. This is the time period we're talking about. And I'm gonna pull out a couple quotes, and please feel free to interrupt me, right? So we can go into what might be interesting about them. One is going back to Buffett's earliest partnership when Buffett started in his 20s. It says, if you had put $10,000 in Buffett's original investing partnership at inception in 1956, you would have collected about $300,000 by the time he dissolved it at the end of 1969.
Doogles, I just told you my year-to-date performance. If we just extrapolate that out, I can crush this.
Yeah, this is like nonsense compared to what you can do. Nonsense.
Jokes aside, that's awesome performance.
30x,
he's a superstar. Yeah,
30x return in 13 years, right? So as this says, Buffett in 1969 dissolved that initial partnership. What Buffett says about this in this piece is this. He sends a letter to his partners, and it says, this is a quote, I am out of step with present conditions. When the game is no longer played your way, it is only human to say the new approach is all wrong, bound to lead to trouble, and so on. On one point, however, I am clear. I will not abandon a previous approach whose logic I understand, although I find it difficult to apply, even though it may mean foregoing large and apparently easy profits to embrace an approach which I don't fully understand and have not practiced successfully.
You've got me fired up today. This is Buffett saying if he's investing in the 90s and everyone else is making, or in the 80s and everyone else is making money in Japan, he's going, I don't know what's happening in Japan. Those valuations don't make sense. I can't put my money there. Like, this is brilliant, but it's so rare for someone to say, listen, I know how I made money in the old world. This new expensive world, basically, like I can't make money there anywhere. It's amazing.
Yeah, it's amazing. And the discipline it takes, which he then, a different part of the piece, it doesn't talk about the discipline, but this is the what's behind the discipline. Buffett saying the enormous advantage the independent investor has, Buffett says, is that he can stand at the plate, he or she in the parlance of our times now, he, she, or they in the parlance of our times now, at the plate and wait forever for the perfect pitch. If he wants it to come in exactly 2 inches above his navel and nowhere else, He can stand there indefinitely until an easy one is served up. Stock market investment is the only business of which this is true. You can not only wait for the bargain, but for the particular one that you understand and know to be a bargain. Gold.
You got to wait for that Iowa-based recreational vehicle manufacturer. You just got to.
Yeah, you gotta wait for that 200 PE stock to come down to 56 PE. That's what you gotta wait for. All right, I got one more in here, which I love here. The portfolio of Buffett's partnership was often too concentrated in a few issues, some not readily marketable, for an investment counselor or fund manager, but not out of line with what might be done by a conservative professional with his own money. Buffett now likes to own a dozen or so securities and characterizes diversification as the Noah's Ark approach. You buy 2 of everything in sight and end up with a zoo instead of a portfolio. What I like about this is like, so I read these other, like the other quotes and whatnot.
Yeah.
And I'm like, oh yeah, that's the disciplined investor Buffett. And I read this and I was like, this is just Buffett. Like he still has this curmudgeon-y, like he's transferred some of the, or like maybe not transferred. This also comes out in Charlie, right? That you got to like dig. You got to have one little dig at somebody else. But I really liked this idea of the Noah's Ark approach, where you're just like buying 2 of everything.
There's another quote I read from Buffett this week, and I can't remember if it's this or another place, but he said like diversification is for people that don't know what they're doing effectively. Like if you know what you own and know its true value, then diversification just hurts your returns. Now, again, Buffett is Michael Jordan, and you can't play basketball like Michael Jordan. So I'm not saying Buffett's diversification approach is right for you, but you and I both run fairly concentrated portfolios in part because we believe this is Howard Marks, right? To beat the market, you have to be right and you have to be different. So if you buy if you buy 100 stocks that meet your methodology, effectively you get this diversification that's just a zoo in Buffett's language here.
Yeah. And what's not negative in there, because it can, given human psychology, when people are told that they don't know what they're doing, they then try and prove that they do. Yep. That's what people do. In this world, the rule is that you don't know what you're doing. The market is fairly random on any given day. Human psychology is hard, etc. So for most people, buy the diversified index. Like we talk about this all the time, right? It's not a bad thing. And in fact, that is you knowing what you're doing, given your own situation in many occasions. So I wanted to say that because oftentimes it can be like, if you don't know what you're doing, that's bad, so now prove it. And that's not the case with investing, in my view.
Absolutely. I absolutely agree.
There's a lot that we can go into there, but
yeah. Can I grab one more thing out of my fishbowl?
Oh yeah.
Quick hit here. I don't think the deal's finalized, but it's been rumored that Microsoft's going to buy 49% of OpenAI.
Yep.
The thing I liked about this is, one, I was mentioning like a couple months ago that I felt like this could be a massive advantage for a search engine. And clearly Bing has been a laggard for a long time. So I think it's a good risk to take from Microsoft's perspective. It's also, I think, rumored to be $10 billion, which is kind of nothing for Microsoft. But I liked how they're, again, rumored to have structured the deal. They take a 49% stake and they get 75% of profits back until that 10 billion is paid off. And from that point forward, I think they get their stake, which is 49%.
Is Microsoft Kevin O'Leary?
Doesn't it sound like Shark Tank?
It does.
But like, I just thought that was fairly creative, and they hedged a little bit of their risk. And the guys at OpenAI, I'm sure, like, yeah, we'll take the money. I think it could end up being a nice partnership, just from afar. I liked how they structured it.
It's fascinating. I also love, independent of how this turns out, I love Microsoft of the last 10 years.
Yeah.
Let's call it. I mean,
I'd say, yeah.
It's kind of the hotness. But Satya took over in 14 or something like that, I think. So like roughly 10 years.
I mean, I love the Satya
yeah.
takeover, because he immediately said, oh, all our Office stuff is going to be available on Apple products. Like, we are a software company, and we're not going to be stingy about who can use our software depending on what product they prefer. They've just taken a lot of really smart bets during that time, and not all of them have worked out. But like, again, $10 billion for Microsoft is almost nothing.
Yep.
And the potential of this technology is massive. It's a really smart move.
Yeah. It could turn out to be, just from my memory, which means this is going to be wrong, maybe a top 2 in a Microsoft investment of the last 20 years. Because if you recall, when Apple was on its deathbed,
yeah,
Microsoft threw change in there. And at that point, chump change as well, because Apple was so cheap. I don't know what they ended up doing with that. So I don't know what the return was, but probably pretty solid. And then this is also, like, again, what you said, chump change.
And then the last thing on chat GPT, I'm on like a nonprofit board, and we used to have a grant writer. And so there was some discussion this week of if we should try and fill a position for grant writer. And I was like, guys, no, I'll write a grant for you right now. I typed it into OpenAI, and literally the grant was better than we could have. Then we could have hired a person to write grants, and 15 seconds later, we're good to go. We can send it off wherever we need to send it off. It's amazing technology.
I keep telling you, man, get Aladdin up in here. We've got a whole new world. Okay, I have one last thing. It's just a quote.
All right.
It is just a quote. So Sam Bankman-Fried came out in the past week and wrote a Substack post. So everyone, if you're not familiar with this, I'm going to let you know. In the US, when you are arrested, there's something called being read your Miranda rights, right? Which is the police officers telling you all your rights that you have. It's obligated they tell you this so that you can understand. One of those things is you have the right to remain silent, and anything you say can and will be used against you in the court of law. Some people don't understand what those words mean. One of those people is Sam Bankman-Fried. So we've already talked about all his jibber jabber. He's been coming out doing interviews, doing all that stuff. He decided, you know what? Video can be faked. I'm going to put it in writing. So he decides to write this Substack post. That is, it's like the true story of what went down from his memory. So many times during this post, he says, well, they took all my documents. But from what I remember, and there's like a graph. Like, from what I remember, here are the exact numbers that came. But anyway,
I mean, he took his memory, put it in an Excel spreadsheet, and then built some graphs.
Exactly. So he does this. I'm just going to pull one quote from it. The whole thing is what it is. I'm going to pull one quote because I read this and I went, if I didn't believe tomfoolery and the rest of it, this says it all. He talks about how Alameda, the risk management of Alameda wasn't as good as it should have been.
Oh, really?
Yeah. but then he says, okay, but in the summer of 2022, Alameda finally put substantial hedges. Okay, that's the start of this sentence. The end of it is in some combination of Bitcoin, Ethereum, and QQQ. Okay,
No.
so his like comeback for, but then we got hedges in place were the riskiest assets, not the riskiest, but pretty solid.
I mean, the riskiest stuff that's commonly consumed almost is like, you can get riskier, but I mean, so he bought QQQ, before the 70% drawdown. I don't follow QQQ closely, but all those stocks have been crushed, right? Like,
yeah, summer of 22 wasn't the bottom. It bottomed out in like September or something like that of this year. So it probably had another 30% drop, I would say, after this point.
I have a challenge with SBF. You
have one challenge?
A lot.
Okay.
I just don't think anything he says is worth my time.
No, and if you haven't read this piece, like, you don't need to. I had to.
He just kills me, man. Like, I now get vibes of and listen, I don't like to throw shade. I'm sure whatever. I'm sure he's a nice enough guy with not terrible intentions.
Don't.
Okay. So he, at this point, he's just like the kid that thinks he's too smart, that has always talked the science teacher, like he doesn't turn in the science project on time, but he's always found his way to weasel his way out of that to like get to the next thing. And it's just like, no, what you did is incredibly serious, impacts thousands of people's financial lives. They still, the team they've brought in is still saying like, we don't even know who we owe and how much we owe. Like, how bad does your accounting have to be that you run an exchange and you don't even know how much you owe people?
I know. And this, I said I would just be a quote, but it's not, obviously. This piece too, the more he writes, the more he shows his ignorance of, like, some of this is just malfeasance. And then there is just ignorance. There was a point where he said something to the equivalent of, if they didn't take my company away, which I picture like it's like his toy, like somebody, but he said, if they didn't take my company away, within weeks, I feel confident that we could have raised enough money to then pay back the customers. But I'm going to send you a Wikipedia article about Charles Ponzi.
Like, I mean, that's my whole point. That's just a Ponzi scheme. So we lost a bunch of people's money, but I could have talked some other sucker into giving me some money so I could lose that money.
Exactly.
There's a reason the keys got taken away, because you don't know how to drive the Corvette, dude, and you never did. It's it's frustrating. I think we should try and take a month or two off that clown. I don't want to talk about him on the pod.
Okay. All right. As long as he stops writing.
Doogles. Don't do it, Doogles.
Thank you, everybody. This is wonderful.
All right. Yeah. Hit us with a review. Find everything you need. SkippyDoogles.com. Appreciate the support as we enter 23, and hope for some listener mail too. So hit us, skippydoogles@gmail.com. Peace.